So thank you very much, first of all, for the organizers for putting our paper on the program. This is joint work with Jack Fisher, who is on the job market this year, Alessandro Gavazza, Tarun Ramadarai, and Jagdish Trupar. So a recurring theme in household finance is that, and in particular in this session, is that households seem to struggle to make good financial decisions. And one leading explanation that we've put forward is that they face complex contracts and product design, meaning an environment that requires their attention and action. In addition, we've also found that there's considerable heterogeneity in attention and action, and hence the prices that different households pay. So less attentive households seem to get worse deals, and as a result, they seem to cross-subsidize more attentive consumers who are cut in on the deal. That implies some sort of regressive redistribution, given that we also know that attentiveness and financial sophistication seems to be correlated with wealth and income. So as a result, the design of financial products and contracts can actually directly amplify financial inequality. So what we're trying to do in this paper is to actually think about how large these effects are, so to quantify these cross-subsidies, and to think about what the potential mechanisms are that drive these cross-subsidies. And to fix ideas, let me give you a brief illustration of how such cross-subsidization can look like. So suppose there's consumers who are endowed with a base good that has a low price, PL, and then they've defaulted. If they don't take any action, they're getting defaulted into a higher price, PH. They can substitute back to the lower price by paying a cost, an action cost K. So by taking action, they can get back to the lower price. Suppose there's unit demand and the aggregate is normalized to 1. And suppose there's firms who sell these base goods, and in particular these add-on goods, which with a higher and a lower price, and just suppose that both of these prices are actually positive. Next, we can assume this differential cost in taking action. So suppose there's some household heterogeneity in this action cost. And suppose that's distributed on the interval, uniformly distributed on the interval between 0 and a K upper bound. We can then define a threshold, K star, that's the difference, right? What's the benefit of me taking action and paying this cost of action? Well, instead of paying PH, I'm now paying PL. So the benefit of taking action is this, okay, we can think of this as K star, and that's precisely the difference between the two prices. So as a result, households whose cost of taking action is below K star will find it optimal to pay the action cost and get the lower price. And conversely, households who have a higher, the other way around. So the other way around. So I talked about the households who have a lower K are going to pay the lower price and they're going to pay the action cost. And households who have a high cost of action are actually going to get defaulted into the high price. So we can write expected firm revenues just for this add-on good as basically, right, what's the revenues for the firms? It's basically the share of households whose K is below K star, they're going to pay the low price, and the remainder households who have a higher action cost, they're going to pay the high price. Now we can think about a counterfactual, a world where we don't have these two prices, a low and a high price, but we just have one price, P star. And when we just write this expected revenues and set this equal to the price, so assuming firms make the same revenues, but instead of charging two prices, they're just charging one price, we get this expression. So P star is equal to these expected revenues, and that implies, quite intuitively, right, that this P star, the kind of single price, lies somewhere, it's higher than PL, but it's lower than PH, so it lies somewhere in between. So that illustrates that the cross-subsidy, right, is basically, in this world, a transfer from high K to low K people. And by going from a two-price world to a one-price world, we're basically redistributing along the K dimension. So we're basically giving high K consumers, they're better off by the same amount that low K consumers are worse off if we now impose a single price. Okay. So we're going to apply this framework of cross-subsidization to mortgage refinancing, and we're going to exploit the institutional setup of the UK mortgage market. Mortgages, as I probably don't need to motivate in this audience, are households' biggest liability, so they are a big financial component of their balance sheet. And there's also ample evidence that there seem to be cross-household differences in how good people are at refinancing. In the UK, the setup is such that there's typically a discounted rate, a lower rate, so a low price. You can think of this as a low price. And if people don't do anything after the initial fixation length, it's going to reset to a higher price, so a kind of a premium over a variable rate. Unless you basically decide to take action and refinance into a new fixed rate contract. We're going to use the universe of the UK outstanding mortgage stock, so that's novel data. That's going to basically give us a view of actually the aggregate lender portfolios in the whole of the UK. And so it's going to approximate a little bit that thought experiment that I just laid out. We're going to build a partial equilibrium model of the UK mortgage market. And we're going to have heterogeneity in both the cost dimension and the refinancing cost dimension, so heterogeneity in K, and also in valuations for housing in order to match the data that we see. And we're going to structurally estimate the model parameters to match the models, the moments in the data. And as a result, using the structural approach, we can actually assess and quantify the size, the magnitude of the cross-subsidy by comparing the actual outcomes to a counterfactual single-rate market design. And we're going to be able to look at the distribution of cross-subsidies, in particular across relevant, for instance, income groups and regions of the UK, to see how cross-subsidies flow from one group to the other. And in addition, lastly, we're going to talk a little bit about what we find are the differential margins of adjustment in response to changing from a dual rate to a single rate regime.
Clarifying question. When you say that in the UK initial discounted rates are fixed and then they vary, is that for everybody? I wasn't listening. Or is it just people that pick up that particular?
So prior to the kind of new inflationary period, the share of variable rate mortgages was very small. So like almost the entirety of the mortgage market, people picked differential fixes. My job market paper is actually about how people pick differential fixes and thinking about that as an insurance choice, but we are going to simplify and basically think of it like as one, we're going
so
to
most people were picking these. It was the optimal thing to do.
Exactly.
Okay.
Yeah. Exactly.
So it's not like in the United States where there's a wide variety of things and people, household pick and choose, and by doing that they kind of self-select. In the UK,
that's right. So you can think of this, for instance, variation and fixation length choice, and that we're going to abstract from that.
But it's what, 80% of households that choose these?
Like 96%.
Okay, well I think that's...
Yeah. It's, and I will say this as somebody who studied the UK mortgage market, it is the setting, the institutional setting of mortgage contracts is a lot more similar across all countries than the US. So actually in the mortgage design setting, the US is the big outlier with these 30-year fixed rate mortgages. Yeah. But I'll talk a little bit about how our setting is actually going to be simpler in terms of thinking about the optimal refinancing problem for the household, so related to the kind of recurring theme that we will have to make fewer normative assumptions about or have fewer unobservables in terms of what's the optimal refinancing decision and in order to infer the cost of the refinance.
Yeah, no, my question was more related to
simpler
selection,
of course.
And you don't have the initial selection problem.
Not into fixed rates, yes.
The way you presented the model, the mechanism of cross-subsidization look very similar to the Bay Lifestyle type of...
that's on purpose, right? That's the kind of...
So if it's like that, it's useful to know because it gives a lot of insight also on what's the role of competition in this.
Yeah. So we think of this market actually as quite competitive. So we think of this as cross-subsidization in a competitive market. Yeah. We're kind of so we're not taking the model from Gerbeck-Saysen, and you'll see it's going to emphasize the kind of features of the model that we need for our results, but it's leaning on the intuition, which is why I use the language that I used.
But just to pick up on that question, a follow-up, which you may leave to later to answer, is if there's competition, why isn't there entry of agents knocking on the doors and people making mistakes, leaving money on the ground? So there's not competition at some point. But we can come. So
I think I think it will be an interesting conversation about why is this the kind of equilibrium regime and why is there no incentive to change it? And I think there's some results which we don't kind of build on them further in the paper, but they may actually point to what are kind of potential frictions in terms of actually implementing the single rate regime.
And that will vary, and this is one of the points across countries and institutional arrangements for selling these things. But go
that's right. But I think typically this is a fairly representative across countries. This is typically what's being done. There's few. I think in Canada actually you get defaulted, which I think is the alternative to this. You get defaulted into another fixed rate, so you don't get defaulted into a high rate, but you get defaulted into another contract. So it's kind of almost like an automatically refinancing mortgage. Yeah.
But sorry, just to conclude on this, I mean, if I remember well, Gregson, the effect of competition in this type of model depends a lot on the underlying distribution of inattention cost, or
That's right. So they have two equilibria, right? Exactly. One is where there's enough unsophisticated consumers in order to have this in equilibrium.
So it is something you're going to try to estimate that distribution.
This is not going to be a model of like explaining the existing, like what caused the equilibrium in the market currently. We're not going to think about what made the structure such that this is the equilibrium outcome. We're going to be relatively silent on that. We're going to take the structure as given, and we're mostly interested in a counterfactual when you take away the two pricing versus single pricing. So it's basically saying in the Gabex-Leifson framework, the conditions for having a cross-subsidization equilibrium are fulfilled, given that that seems to be what we're seeing in the data.
But just to wrap this, let's come back to this a little bit later, because we will have to discuss that if we're ever going to make normative policy statements. So we'll come back to that issue.
Sure. All right, so let me give you a bit more detail on the UK institutional setting that we have. So as I said, households have these mortgages that pay discounted rates for an initial fixation period, so that's either 2 or 5 years. We're going to focus on a 2-year. And then after, if you don't do anything, they're going to automatically revert to a relatively high, you can think of it as like a penalty rate, that's like a premium over the floating base rate, the Bank of England base rate. That pricing scheme actually looks a bit similar to other pricing schemes in credit cards, cell phone, and electricity plans. And also to note is that, and that's a bit different than, say, the Canadian framework, is that pricing is done mostly on observable product characteristics. So the vast amount of variation across mortgage rates is going to be based on the rate type, the fixation period, and the LTV as a measure of the credit risk. And yeah, prices are, so basically the point is that there's no exposed negotiation that happens. So the prices that lenders put online, these products, we can actually verify that they show up exactly like that in the origination data. So conditional on observables, there's very limited exposed negotiation and price variation. There also seem to be limited frictions to remortgaging. So there's a 2019 study by the conduct regulator in the UK, the FCA, that notes that remortgaging is fairly easy. Most often people do it with the initial lender, which has even fewer frictions and actually relatively low, just pure financial costs. But in order to avoid that, we're going to basically make a revealed preference argument, right? We're going to back out the cost that is going to justify your refinancing decision. And if we see some people who are not refinancing, but they would like to refinance, but they can't, we wouldn't want our results to be driven by that. So in order to just guard against that, we're going to filter out people who would like to potentially refinance, but actually just can't because they're not eligible to do so. So we're going to filter out mortgage prisoners, and in particular, and being a bit more conservative than that, we're going to filter out people on very high LTVs, people who are in negative home equity, and who have potentially missed some of their payments. And we did the exercise, we did it as a robustness check. Our results with and without were broadly unchanged. Also to note that in the UK we have this structure, this kind of incentive to refinance after the fixed rate expires, makes the optimal refinancing problem fairly much simpler actually compared to, say, the US 30-year fixed rate where you can freely refinance and kind of have to optimally compute an option value of refinancing. So there's these significant refinancing incentives exactly at that point. It also allows us to move beyond what could potentially drive refinancing, in particular in a setting like the US, which is unobserved moving propensity. So there's, if you're more likely, there's an unobserved shock to your moving. In the US, you would have to refinance it, so that could actually drive your decision. And so inferring the kind of costs from that is much more difficult in that kind of setting. Whereas we do some simulation exercises where, under a vast array of calibrations for the interest rate process, it's optimal to refinance just when the reset rate sets in. In addition, there's also high prepayment penalties that deter early refinancing. So it's basically, you get very predictable prepayment in the UK mortgage market, which is also which is why I think lenders have the contract structure is as it is, because it makes it easy for lenders to hedge the interest rate exposure. So they take out swaps typically that match exactly the fixation length, because that's typically how long people stay in their contracts. And that also allows lenders to actually hold these 30-year fixed rate, 30-year mortgages on their balance sheet. So 80 to 90% of mortgages in the UK are actually held on balance sheet. So that's part of where some of this contract structure comes from. Okay. A bit more on the data. So we're sourcing this data from the Financial Conduct Authority, which tracks the stock of all outstanding loans in the UK issued by regulated financial institutions. And these are snapshots, basically snapshots of the mortgage stock at half-annual frequency. We have data from June 2015 to December 2017, but because we're modeling the kind of stock in steady state, we're going to actually focus on just one snapshot of the data and using some of the remaining data for cross-checks. We're going to mainly focus on this distinction between discounted and these reset mortgages, so like thinking about a low price, a standardized low price, and a high price. And which is going to leave us with around 3.5 million mortgages and about £500 billion UK pounds of mortgage debt. We have granular mortgage details that we can track over time. We have some borrower characteristics. We can, to some extent, merge them with information at origination, but for our purposes, we're mostly interested in heterogeneity, in particular across income and location. And just to note, this data set has been used in other studies of UK mortgage markets, including myself and some co-authors. All right, so let me give you a first view of the data. So here's the average interest rate on discounted and reset rates over time. So the blue dotted line down here, you can think of that as PL, basically. And the reset rate in red is basically PH. And the difference, right, the average interest rate differential in the period that we're going to focus on is around 55 basis points. And that is equivalent to the benefit of refinancing per unit of loan, right? So if you choose to refinance, instead of going to the reset rate, you're going to the discounted rate, and so you're going to scale this interest rate differential by your loan size. And that's going to be your refinancing benefit.
Is there any negotiation on a discounted rate?
No. So that's what I was emphasizing.
Okay,
it's actually like a bank rate, like a bank specific rate.
So there's no point at which there's negotiation at all. It's everyone gets homogenous.
Exactly.
Okay.
Exactly. Yeah.
Now there's a lot, and this will come up later. There's the perceptions of particularly less literate borrowers may not be that. It may be that there may be negotiation, there may be issues. That's factually correct, but whether people perceive that is a completely separate matter that is well studied by the companies. But question,
Yeah, no, I don't know the UK, but I know the Spanish mortgage market. And what happens is that the banks that offer the mortgages make the money out of a lot of services related to the mortgages, like the insurance, making sure that the client has, the paycheck going there, and a bunch of other things. And in some ways, they don't make the money. I mean, I'm sure they make money on the mortgages, but what they make money is about all these other bundles that they sell. And a lot of times, the client doesn't change when they refinance.
So
how much of that also happens here? And if it does, it makes your model a bit more complicated.
I think if we think about if we take a broader view of cross-subsidization, I think it seems to be in line with how lenders seem to be developing their business models, that there's cross-subsidization across different product categories as well. We're totally abstracting from that because we don't have the data on that. I think in the UK, typically, you do get some bundling between, maybe you're more likely to take a mortgage from the bank that you have your main deposit account from. in terms of how much people switch around, it doesn't really matter for us if you switch with your current lender, which is also very common, or outside. So there's a study by the FCA that found that the rates people obtained, conditional observables, were relatively similar, but I think there's interesting things that want to study there for sure. And it's about, the split is about 2/3 to 1/3. Okay. Yeah, but the fact that I think the main thing for us is that people like this. It's basically a household's decision to refinance or not. So lenders can't kind of like if they basically, this is kind of centralized pricing. So they put out these contracts, these new rates, say, and you as a household would be able to obtain that rate if you decided to refinance.
But the overall rate is not for everybody. I mean, you said that the discounted rate is the same for everybody, but not the overall rate.
The overall rate is, that's just to make that clear, yeah, that's conditional and observable. So if you have the same LTV and same product, then that's for everyone. So there's very limited, you can check if there's price differences. Very few lenders have any price differences between first-time borrowers or their refinances. And that's I think a useful feature, that there's very limited within bank across borrower discrimination. Great, okay, so here's another useful empirical fact from the data. So this is basically the stock of loan balances in the mortgage data. So these are, what I'm plotting you separately is basically the distribution of loan balances on the discounted rate and, in blue, and on the reset rate in red. And around 70% of mortgages by loan balance are on this discounted rate in blue, and around 30%, so a significant fraction, is on the reset rate. And what you also see is that there's a difference between the average loan balance, which is in line with what we probably would expect. So loan balances on the discounted rate are typically larger, because that's basically if the refinancing benefit is basically scaling with the loan balance, then you have a bigger incentive to refinance, all else equal, with a larger loan balance. So we may expect that, but there's actually substantial overlap between these two distributions as well. And one thing to note is that the variation, why is there distribution? It could actually, the distribution actually can come from two sources. First of all is that there's variation in just the initial loan balance that I take out. And in order to match that, we're going to have this heterogeneity in valuations as well. In like how much households value a size, a given loan size or a given house size. And there's also going to be, what could also cause this difference in loan balances is actually that some loans say on the reset rate may actually just be older loans. So they've repaid, given that there's a full amortization path for most of these loans, they've repaid a bigger share of the loan balance. Okay, so with these facts in mind, how should we build a model that captures these facts? So ideally we want to capture different loan sizes. So as I said, this is going to be modeled as an intensive margin decision, basically having a heterogeneous valuation for housing. So how large do I want my loan size to be? We're also going to capture heterogeneity in refinancing costs in order to match that there seems to be this big fraction of people on reset rates, even with high loan balances. So we're going to have a persistent component of K, so that's this is kind of enriching the very stylized kind of initial snapshot of the model. And we're also going to have a time varying in action, so random shock to refinancing intention that's going to scale, that's going to be multiplicative in the persistent component. We also want the model to map to the stock of mortgages, not just the flow. That has advantages. First of all, as I said, it measures the full lender portfolio directly. It captures behavior also across the maturity spectrum, and we're going to have estimated parameters that are not going to be estimated basically just on trends in origination. And lastly, we want the model to be easy to aggregate in order to basically be able to rebuild these loan balance distributions that we saw in the data and see where different cross-subsidies flow from where to where. All right, with that in mind, so here's an overview of the model. So households, first of all, they enjoy per period housing value VI. That's the housing valuation. That's basically the two dimensions of heterogeneity, so they're going to differ across V. And they're also going to differ across a fixed cost, which is KIT, which has this basically case I-specific, household-specific component, a persistent cost of refinancing, as well as a household-specific multiplicative shock that is potentially time-varying. So we're going to model that as a non-negative IID log normal shock. And the valuations and costs are described by these joint CDFs and PDFs. So mortgages are going to be fairly simple. So we're going to focus on the median and kind of the most common type of mortgage is the 2-year fixed rate contract. So we're going to basically rescale everything and think of it as T is going to be 15 periods for a 30-year mortgage, given that each refinancing spell is basically 2 years. So the discounted rate is going to be RD, and that's going to be in place basically for the rescaled 1 period. The reset rate is we're going to denote that by capital R. It's going to be higher than the discounted rate. And if you don't decide to refinance, if you don't pay that cost, the refinancing cost, you're going to get defaulted into the capital R. Households make 3 different choices. So at T equals 0, they're going to, first of all, make an extensive margin decision of entering the housing market at all or renting. And conditional on deciding to enter the housing market, households are going to choose a loan size LI0 to finance a property priced at HI. So basically they have valuations for housing, but we're going to keep the LTV fixed just for simplification purposes. And so basically households choose the loan size that they want. And every period, households basically decide to refinance or not by paying this refinancing cost. Okay, so how do households optimally refinance? That's going to have a similar intuition as what I've outlined already. So households refinance when the overall refinancing cost is below a threshold that is now, rather than just being the difference between the 2 prices, is going to depend on the loan balance. And across households, obviously if you have a larger loan, that's basically a larger refinancing incentive. That's going to increase the refinancing likelihood. And over time, as I already said, the refinancing incentive declines because you're amortizing the loan balance. Some households almost always refinance because there's this cross-sectional heterogeneity in the persistent refinancing cost. So if you're a very low persistent K, that's going to make you almost always want to refinance. We're going to solve for the optimal refinancing path by backward induction. So in the last period, we're going to refinance if your cost in that period is below the cutoff point. And the cutoff point is basically, right, if your cost is below, if the cost of refinancing is smaller than the benefit of refinancing, then you would refinance. And the benefit of refinancing is the mortgage payment. This is just notation. Mortgage payment using the loan balance given the higher rate with 1 period left. Or minus the mortgage payment that you would have under the discounted rate, and that's just the scale difference of mortgage rates scaled by the loan balance. Okay, so we can generalize this now, so it will be helpful to basically define a value function before the epsilon shock has realized. So basically, households are going to minimize mortgage payments, right? So that either you're going to, if you take out the reset rate, you're going to have that mortgage payment, and you're going to want to minimize that, or the alternative is to have the mortgage payment under the discounted rate, but paying the refinancing cost. And how can we write this expectation? Well, the cost on the discounted rate is just going to be the households basically whose K, so the K times epsilon is going to be below K star. That's just a renotation of the integral, right? So the epsilon is such that multiplied by K, it's going to be below K star, and households on the reset rate, it's just going to be the opposite, who are above this K star. So similarly, we can define this value function in a generic period, and that way we can get a refinancing threshold for all periods, taking into account these expectations. And so the optimal refinancing policy is going to be you take out the discounted rate if your K is below this K star, this refinancing threshold, and you're going to not take any action and get the higher rate otherwise. Now, once we've solved for these, so these were refinancing paths conditional on a given loan size. So once we've solved for that, we can come back to the initial loan size. So how do households pick the initial loan size? Well, they're going to maximize the value function at origination, which is all your future flows from basically living in a house of a given size, which has some concavity alpha. You're going to pay an origination cost for the mortgage, and you're going to pay basically the mortgage payments. And so what we can see from this expression is that the optimal loan size that households are going to choose depends obviously directly on their valuation for housing. So how large is the house, do they want the house to be? And indirectly on the persistent component of K, of this refinancing cost, through the optimal refinancing policy, right? So depending on the K, the households are going to think about the refinancing path and the costs that they incur. And if you, for instance, if you have a higher persistent K, you're kind of internalizing that the mortgage cost is going to be higher, and you're going to scale back your loan size as in kind of consistent with that.
Just to clarify, so these are households that are armed with an additive intertemporal utility function?
That's right. That's right.
They're intertemporally risk neutral.
Yes, exactly. That's definitely a simplification.
So
we're not going to have concavity over like the variation or variability of your interest payments.
And non-additivity there might lead to something that others call inertia.
Inertia, we're going to. It's a little bit related to the way why we introduced this this stochastic component to the refinancing cost. So that captures a lot of different. It's like a reduced form way of capturing a lot of different types of behavioral biases that may, for instance, be time inconsistent.
Yeah, that makes me, when someone says reduced form way of capturing a lot of behavioral biases, none of which I actually believe, I get very nervous.
So it's a bit of a, we're imposing a less restrictive prior, right? Because we are equally uncertain about which one is the right one to model, and rather than doing that, we're going to capture that element. We're going to capture that idea that people may kind of wake up and suddenly decide to refinance. So that for instance, would be right, something like that, inertia, yes. The extensive margin condition can be defined by just having the housing valuation at which households, so basically households are going to get a house if the value function origination is bigger than the outside option, which is this per period rental utility U bar. Okay. Now, in order to basically, we're going to model derive these distributions of loan balances that you saw. So in order to do that, it's helpful to define these three different groups on these two different types of interest rates, right? So there's a group 0, which is going to be on the initial discounted rate. That's going to be new households who are just entering the market, and we're assuming they're taking out a fixed rate, which is consistent with the data. So these are going to be households who are also satisfying the extensive margin condition. Secondly, who else is going to be on the discounted rate? It's going to be households who decided to refinance in the previous period, and they're going to also be on the discounted rate. And lastly, households who did not refinance are going to be on the reset rate. Okay, so with that in mind, just an overview of the structure estimation. So the model thus allows us to aggregate these outstanding mortgages. So we're going to actually match exactly that in our structure estimation. So we're going to generate a distribution of mortgages on a discounted and reset rate. This model is going to give us basically a model implied distribution. Mm-hmm.
So is TD chosen such that they can refinance multiple times within one mortgage?
So TD is just fixed in this case.
Okay, so do they refinance multiple times? Do they have the opportunity to?
Yeah, absolutely. Every period you decide to refinance.
Every single period. So I'm a bit confused. So is TD set to 1? Like they refinance every single period?
So that was what I was trying to explain earlier. And it's basically rescaled because the refinancing spell is basically like every 2 years. Okay. So we basically have 15 refinancing spells at which you can decide each 2 years for a 30-year loan.
Okay, so the 4 slides ago about the optimal refinancing decision, that's modulo TD.
Yes.
Okay, thank you.
And we're going to match the moments from these distributions of mortgages in the stock data with the model implied moments. And in particular, the structure parameters that we're interested in, the parameters that we're estimating are the distribution of housing valuations and refinancing costs. So how large are these and how dispersed are these? And also in the variance of the temporary component of this refinancing cost shock, so the stochastic shock to the refinancing cost, as well as utility parameters. We're going to have 3 versions of the model. We're going to have an aggregate version, and then also we're going to estimate a more disaggregated model in order to do these cross-subsidies across groups. All right, so let me start out by showing you the moments that we're matching and how the model does in terms of matching these. So first of all, what the model matches well and what we want the model to match is these differences in the loan balance that you saw. So the model seems to be matching well that households on the discounted rate on average have larger loan balances, and households on the reset rate on average have smaller loan balances. But in order to account for the fact that this is not just their housing valuation, this does not just reflect their housing valuation when they took out the loan initially, we also match the fact that households who are on the reset rate here are on average a bit older. They've been in the mortgage stock for longer. we also want to match basically to what extent households respond to their refinancing incentives. So this is the loan size distribution and the share of households who are on the discounted rate. And so you'll see that there is an increase, but the steepness of the increase, how much people respond, if this was very steep, it would suggest that costs are actually relatively low. Whereas what we see here is that there is a slope, but it's going from around half to around 80% when you go through the loan size distribution from the 5th percentile to the bottom 5th to the top 5th percentile. And we're matching the model, and seems to be matching that quite well as well. And lastly, the moment that's going to determine, allow us to figure out how big this shock to refinancing potentially is the only way we can match an observation in the data, which is that households seem to be switching back from the reset rate back to the discounted rate. It requires some kind of shock, given that refinancing incentives on average are going down. So we need to have a kind of a small shock to K in order to say that in order to match the fact that some people kind of wake up and refinance after they haven't for a while. And lastly, we're also going to match the share of owners versus renters in the UK economy.
Just a quick clarifying question. How do you deal with if they sell the house? Is there any type of, they drop the house in that sense, or?
We're not matching that. We're basically not allowing for, we're not capturing moving or anything like that. We're just capturing basically like the aggregate share. So we're basically assuming households stick in the house for 30 years.
And also there's no sense of strategic default or anything like that? So
the UK is a full recourse, country, so that's less for concern. All right, so here's some intuition from the estimation. So what we find is that there's large heterogeneity in the net benefits in a cross section, but it's not that the benefits are the benefits vary quite that much, but it's that the costs are actually much more heterogeneous than the benefits. So this, in order to match what people are doing, in order to match how many people are in particular on the reset rate, we need to assume that households seem to have a lot of variation in their refinancing costs. And also, there's large heterogeneity in the time series, so that basically is a share of periods looking at households' refinancing paths overall, throughout which they're on the discounted rate. So there's some households who are basically almost never refinancing other than the first period, and then there's some households who have such a low K that they're almost always refinancing. Okay, so now moving on, after we've built all the machinery, let's move on to thinking about cross-subsidies. So the way we're going to think about the cross-subsidies is basically using that example from before. We're going to think about a counterfactual, and instead of having these two prices, we're just going to have one single price. In this case, we're going to set it to the value-weighted average rate. We have different alternatives for that. And that's basically, we think of it as like a thought experiment. Like if the rate was not these two rates, what's a reasonable rate that lies somewhere in the middle, and how would households respond to that? The optimal loan size, in this case, will maximize the value function at origination evaluated, given that there's no refinancing cost, but they all just pay the same rate. And we can then compute the aggregate numbers and the loan balances of mortgages in that counterfactual scenario. We're also going to apply the model to different groups. So we're going to have group-specific parameters, and that way we can look at cross-subsidies across different groups. So here's a first overview of some of the model results. So what we find in the counterfactual, once we go from a two-rate to a single price kind of regime, we find that the number of mortgages goes up in the UK-wide example, but also in the other more disaggregated models. And the mean initial loan amount goes down. So what's driving that? It's basically that households who have large loan balances, right? They had large refinancing incentives. So the overall refinancing path, they paid lower rates in the two-rate regime. And so now that they're going to pay the single rate, on average, their refinancing costs or their mortgage costs are going to be a bit higher. And so in response to that, they're going to scale back their loan balance. In addition, though, the reverse is true for households with small loan balances. So their mortgage costs on average go down a little bit. And so because we're assuming kind of a continuous distribution, there's going to be people on the margin that are actually going to enter, given that there's a reduction in mortgage costs.
So the interpretation is like 4 percentage points decline relative to...
Exactly, yeah. So exactly. So there's a scale to the status quo, exactly, the two-rate regime. Yeah. I should speed up a little bit. So let's move on to the cross-subsidies. So now we're basically estimating the model across different groups, and that allows us to think about the average interest rate, the average loan balance change, and the average payment change that these different groups have as a result of the counterfactual, and we see which groups are better and worse off. So there's actually considerable within group variation, so even within high income households we find quite some heterogeneity in costs. In this case, because we're emphasizing the cross-subsidies, we're going to focus on I'm going to talk more about the across group distribution of outcomes. So first of all, here's how mortgage costs are going to change. In the left panel as an interest rate, expressed as an interest rate, and in the right panel expressed as a cost, taking into account the cost of refinancing. And what you see is a positive slope, which means there's progressive redistribution as a result from going from a two to the single rate regime. So higher income households are going to pay slightly higher mortgage rates, and lower income households are going to pay slightly lower mortgage rates. So everyone above the 80th percentile is paying higher rates. And that effect is actually primarily driven, so this is a result actually, we didn't find that households on average and higher incomes had substantially lower case. This is mostly driven by the fact that these people have larger loan balances and hence bigger incentives to refinance. Just to give you a sense of magnitudes, households here, the all-in kind of reduction in mortgage rates for these low-income households would be something like 1 to 2% of the mortgage interest cost once you compound the interest payment. So that's kind of substantial, and which will help motivate some of the results that we find in terms of loan adjustments. So these are both the number of mortgages, so we get entry as a result of mortgage cost reductions at the margin. But at high income in particular, we're going to get these loan size, so intensive margin adjustments. These households are not marginal, so they're going to basically scale back their loan size in a response to mortgage cost increases. And just to show you another dimension of redistribution, we also find that there's progressive north-south redistribution as a result of moving to the single rate regime. So the north of the UK is typically a bit poorer than the south, and we see that the interest rate basically goes up in the south, similar to the mortgage cost, and the take-up basically goes up in the other direction. And just before I conclude, let me just recap. So we find that the redistributive effects in the framework, they depend both on the refinancing cost, so that's the redistribution along K, but also on your the kind of refinancing benefit, which depends on your loan size, your valuation for housing. The status quo penalizes obviously high K households, so they pay higher rates. But it also penalizes low V households, which are typically lower income, because they have a smaller V, so they have a lower refinance, like the incentive to refinance is smaller, the loan down scales with the refinancing incentive, and that's going to be smaller for them. And so they spend less time on a discounted rate, just rationally. So which is why we get these differential adjustments as well. So there's this extensive margin adjustment for low-income people, because they're kind of the marginal households who benefit from marginal decreases in their overall mortgage cost, and large effects on the intensive margin for high-income households who are more likely to adjust their loan size rather than their mortgage decision. So to conclude, we structurally estimate refinancing cross-subsidies in the UK mortgage market. We match broad features of the data with realistic parameters that highlight significant cross-household variation in refinancing costs as well as incentives. We study the effect of removing the cross-subsidy on the composition of the mortgage stock. And we find that there's greater take-up for poorer groups and regions, which means that there's, in a sense, a democratization. Mortgage rates are now more similar of mortgage take-up in a single-rate world. And more broadly, we hope that we put forward a methodology that allows us to study cross-subsidies and think about inequality in consumer finance more broadly. So in our case, richer households benefit due to both the larger stakes that they have, as well as the greater propensity to take action. And so as a result, complex product design, which involves costly action, disproportionately affects the poor.
Thank you so much.
Okay. First of all, thanks for inviting me to discuss this paper. It's a pleasure to discuss this paper. Lou is also a co-author of mine, so the price of being perfectly honest is supposed to be low. And of course, this is close to work that I've done, not just this paper, but also a paper with Lou on loss aversion in the housing market. Okay, so if I am to wrap this paper up as I read it, then what Lou and her co-authors are doing in this paper, which is a little bit different, is that they're trying to put the money size on behavioral biases instead of trying to model behavioral biases. So in the paper with John and also with Lou and other people in this literature is that they try to build a behavioral model to actually get at the behavioral preferences. What I actually appreciated with this paper is instead of trying to do that, which may or may not be correct, and Glenn had a feeling about how to model behavioral biases, they're trying to put a money size on it. And I actually appreciated that when I was reading this. So the story, as I read it, does the cost of mistakes differ within convenient brackets, and how will household react if we enforce one size fits all? So that's all of the story. And I am going to challenge that with what you and Tarun have done. So in our work together, I usually smiled when I saw something didn't fit, and then Tarun would get all worried. Right? So I'm going to put the smile test on today and take it as a friendly input. That's wrong. That's the table of the experiment. So first, already in the questions when you were presenting, people were challenging this. Can we actually do this exercise in a partial equilibrium setup? Right? In the sense that when I read this, if you change the interest rate, the market's going to change. Right? So there's a supply side to this mortgage. So even if you enforce it, we don't live in China, we can't decide what the interest rate should be. The market sets the interest rate, and when you enforce this rule, the market reacts to it. And maybe the market has actually built in smarts to try to make it as cheap as possible for people, or the competition has built a system. And I'm going to give you an example of why I think this is a challenge, right? Okay, so you experiment here with the one size fits all. It's the opposite of what we did in Denmark. I couldn't find the exact quote, but I remember it because it was like in 2001, 99. That we went from a one rate, no discrimination mortgage market to like, do whatever you want, right? So we went the other way, one size fits all, to like a diverse market of mortgages. So the statement then, when the politician decided this, or the minister who was in charge of this, is when people challenged it whether households would actually be able to manage this, is that it's not illegal to be stupid, and people have to realize the choices that they're making. So if I go back to why I don't think this is or why I think you will have a challenge with doing this in the partial equilibrium, let's think about the teaser rate being an instrument or indicator for people who are not able to manage the debt. So these are the people who don't refinance, is the people who are going to default on their loans. Okay? So the mortgage market, the mortgage bank or the banks are not allowed to discriminate. They're not allowed to sort of ask, are you bad at your debt, or ask whether you have unserved debt. But they want to have an instrument where they can sort the people who will actually repay their debt and not repay their debt. Right? And then they use the teaser as an instrument, right, to sort of provide the mortgage to everybody. But then the smart people that refinance are the people who are not going to walk away from the debt, but the people who don't refinance has a proportion to stay at the high interest rate, right? So if you remove the teaser rate, they might just increase interest rate for everybody. So it's not about distribution, it's about the behavior that the people that don't refinance might be paying for the high interest rate.
Like the limits, not the reverse.
It's to get the limits, right? It's to get at the limits. So that's why I think if you want to make this statement about redistribution, you have to have the equilibrium in there. Okay. Now I'm going to give a comment. So the way that you build this model to estimate the costs is by this mixture type of model. So you didn't say that in your presentation, but basically the way that you do it is that you have two types of households. A household would be two types. It can be low cost or high cost. And then you have this log normal distribution that you then estimate. The reason why we usually do that is because we expect the distribution to look something like this. Right? You have a mass at the bottom or mass at the top, or you have two nodes. Right? you gave me the estimate, so the first thing I do when I get this, after Glenn taught me this many years ago, is that you plot the distribution of them. This is how what your distribution looks like if I plot your parameters of costs. And then you can say, okay, you're only going up to 200, but if I do this, it looks like this. If I do this, it looks like this. You do not have a bimodal distribution how you estimate it. It's not that, take this critique as you don't need two different types then, or you need something else in the data. So when you're matching these moments, I doubt that it will, like numerically, I think the computer is telling you I can't do this. Right?
Or it's saying it's a mixture, it's a hood.
It's something else, right? But what I really, so going back to what I appreciate about this paper is its identification of cost, instead of trying to call it like what is the consequences of your bad choices. Okay? And I think that you should work with how you actually specify this. Okay. So David Leibson and Mastek and Benjamin Moore is a co-author of our colleague of one of the co-authors, actually have a model that does pretty much this. I am pretty sure that you know this paper, right? And the way that, because they thank you in the abstract. So they have like a way to sort of phrase this. So the way that they, incorrect in my mind, do it is that they actually look at present bias. They don't look at this cost, right? But that's a different angle that you guys could take at this. Okay. Okay. I'm on time. Okay, and then, so when I read the paper, one of the core messages was this heterogeneity in size, right? And you say there's cross-substitution between income groups or regional groups. When I read the paper, I did not see one place where you actually look at how that fixed cost varies across the groups. Right? So all I'm getting is the average. You estimated the model on these groups. So when I go back, like the moments that you're estimating, you say you're estimating 9 moments, 12 groups, 119 many moments, right? That the coefficients, but I don't see them anywhere. And that actually got me a little bit worried. After I plotted this, say, okay, I can't actually identify a bimodal model, and you're not presenting me with the heterogeneous estimates, I'm not sure how much noise you have on each of the groups afterwards, right? So it's like it doesn't pass this smile test. Okay. There's no description of what and how precise these estimates are. When you read the paper, there's absolutely no ability to do any sanity checks on what you've done. Right? Okay. Minor comments. When I looked at this is the fit, you didn't show this graph of the data and model. When it's figure 1 in the paper, and you can see these blue dots, and then you see the red, and then you see the legend, and you say that's data, the blue are data, and the model is the red dots. And then you go, usually the data is the noisy part, and the model is smooth, right? Whether you switch around, actually to me, it looks like, I don't think it's a label mistake. I think it's because there's not enough bootstrap. When you did the bootstrapping, it's not smoothing it out enough, and that's probably because it's not identifying the parameters precisely enough. Okay?
I agree with the former, not the latter.
The what?
I agree with the former, not the latter.
Okay, that's fair enough. Okay, and then when you do the simulation for this, what does your result mean? What does your policy treat mean? No standard deviation compared to the noise. You're taking the parameters from your model as true values, and then you're plotting it in. So I actually don't know whether this is number of mortgages down here, 95%. Is that 50% to 150%? I have no clue from the way that you presented it. Okay, I'm done.
Great job.
you.
Yeah.
So what I appreciate about my co-author session is that you can rely on him never to make support. So I really appreciate your feedback. I just want to I think clarify like some of the major, more bigger points. So I agree that this is partial equilibrium, and it's always like more complete to have a general equilibrium model subject to being able to capture and emphasize what you want to capture. And I think in this case, there's actually, you can come up with cases. I think the general equilibrium kind of product innovation outcome after you do a major policy change, I think modeling that as like making that endogenous in your model is, I think, quite hard. So like endogenous product innovation, what's going to happen to how a lender is going to innovate around that. I think that's like a key concept. I totally take that. I think it's hard. We didn't do it. The partial equilibrium point about defaults is actually something that we should probably emphasize more in the way we lay out the paper. But basically, in the mortgage stock, the average LTV is 55%. Okay, so like house prices can go down 45%, and the lender is still good. So these are not households that are kind of at the margin of defaulting. This is like, I think a lot of our the reason why we emphasize, I think, is emphasize this kind of default region is mostly households who originate their loans. They're relatively fresh. It's like a subset, and there's a lot of action in terms of like responsiveness and everything. But in this exercise, when you look at actually like if you issue 30-year mortgages and what's the overall portfolio that lenders make their profits on, the average, the kind of vast majority is going to be very low risk. So I kind of hold that against the we need to have a partial equilibrium model where we endogenize default. I'm interested about the mixture distribution stuff. So we don't have a very strong view on this. We kind of decided that this was a better fit. I don't know how you did. I would be curious to see how you do the distribution because the K is unobserved, right? So we don't know the true K. We can't fit the true K.
Yes.
Yeah. Oh, sorry. I should probably let you guys ask questions.
I mean, these are good things to discuss.
Yeah, exactly. So, and I think, for instance, the K, like modeling present bias, is, as Peter has told me, like frequently, is very difficult to do, like the time consistencies and like it imposes a lot of restrictions. Like if you model a certain behavioral preference very, very carefully, it imposes a lot of restrictions on what you can do with the model otherwise. And so we think of the K, this kind of what I was trying to express earlier, the stochastic K, it could be something like present bias, right? You're making time inconsistent choices in that sense. Yeah.
Good.
Great.
Any
Look forward to
questions?
any other questions.
Yeah.
So I'm just curious about measurement and the ultimate headline number. So what is the monetary cost? How many pounds? What are the measures?
So for the households, for the lowest cost households, it was something like 1 to 2% of the overall mortgage cost. That's going to change. Yeah. So in a way, one way, we didn't frame it like that. In a way, you could say they're not massive in a market like the UK where you have relatively frequent refinancing, actually, like where it's common for people to refinance. There is some heterogeneity, but it's not maybe as large as you may have.
Let me pick up on that point, if I may, because I think it's also going to relate to the broader literacy theme that we're looking at here, and that is one of the things that's actually interesting is having a department where people actually teach this stuff. We have actuaries in our department, underwriters, talking to Conrad in there, and I've given lectures on this matter at Swiss Finance Institute. We teach people this thing called behavioral inertia. We teach underwriters and actuaries to do that, to make money, partly as the instrument that Stefan talked about. I've actually been in Rüschelkorn, the Swiss Re place, talking about our était parameter, this correlation version. They are modeling that structure to make money. You see it most clearly in new products. Take cyber insurance as a classic example, where many companies have deliberately gone in and taken the excess lines, taken the stop loss, they've actually run losses to do what? Learn about the distributions. Are they double mixtures and whatever? So that's called, in a Bayesian sense, expected value of sample information. It's a logical thing to do. So they're modeling this reduced form. It's a really important institutional fact because we're farting around. Oh, it might be beta, it might be this, it might be rank-dependent utility, it might be this. We'll call it K. No, the industry has been way ahead of us for 10, 15 years. Let's just find information about that and talk about those structural models is the point.
So I think one way to come back to some of the earlier questions is to think about this seems to be the heterogeneity, the refinancing inertia and distribution of K that kind of can be sustained in equilibrium where you have free entry, or for instance, like there's a fairly lively and increasing market of brokers that actually have an incentive, right? They make money off your refinances, they get a cut of that, so they will call up households and actually kind of remind them of their refinance. So you kind of get, this is kind of the degree of cross-subsidization that you get in the market with freelance.
But again, let's come, it's the same point raised with respect to Philippe. We're going to call this a bias, we're going to call it inertia. We've got lots of papers coming on this, so this is not just new here.
So I should take it back, because the whole paper is about, we don't call it, right, it's the redistribution of costs.
No, I understand, but then underneath it, when we want to design policy to mitigate it, we're talking about this as inertia. That's the language you'll see in many papers here. Another explanation is, and it may be wrong, is it could just be a preference. This runs all throughout Ben Handel's work, for example. That has dramatic implications for policy. So that's all I'm trying to get at is, I appreciate what you're saying, but the other problem is we're sort of saying it's a reduced form. That's okay for your purpose.
I think like for us it's exactly consistent. Right? We're taking revealed preference very seriously, and to some extent there's some case where you're like, that could be a rational case, and some of these cases are really high, and then it's up to you to then say this is maybe a bias.
We'll discuss that. We'll discuss that more. We'll discuss that more. No. Of course it's your paper. That wasn't my point. I said, but in terms of my point is in terms of the policy significance of what we're talking about here. That's all. That's all. Any other final questions? Excellent. Thank you.